Hello everyone, it's great to be in my office recording this next exercise. If you hear any sounds or disturbances, I apologize. We live in a noisy world, so let's get going. We're looking at asset disposal, an exercise on asset disposal. Company B purchased a vehicle at a cost price of $300,000 in cash on the 1st of September 2004. So you know the dates are important. We get all the information and then we're going to put it into our timeline and get a picture of what's happening with this vehicle. On the 1st of July 2005, the vehicle was sold on credit for $250,000, bought for $300,000 in September 2004, sold 1st of July on credit for $250,000. Record in the general ledger accounts all the transactions for the years ending the end of the first year, 31 December 2004, and the second year, 2005. Everything relating to the purchase, the depreciation, and the disposal of the vehicle. So we bought a vehicle and we're going to get rid of a vehicle. Vehicles are depreciated at 25% per annum on the reducing balance method. So that is the carrying value. Depreciation is done on the carrying value. The reducing balance method or the diminishing balance method, same thing, but as we go on, you will see exactly what I mean. I just put here the events on the 1st of September 2004, the purchase of the vehicle. You're going to see for the remainder of the year, depreciation is going to be done at year end. And then the next year in July, the vehicle was sold on credit for $250,000. So hopefully that makes all this writing a little bit clearer. So the first thing we need to do, and I'm going to do the journal entry. This year, this transaction was recorded through the general journal. A cash payment normally done through the cash book payments or the cash payments journal. But remember, it doesn't matter because we purchase a vehicle. Vehicles will be debited. Why? Because the value of our asset vehicle has increased in our books by $300,000. The date was September the 1st. And bank is credited because this was purchased cash. And bank is an asset, which is a decrease in assets. And the rule says decrease in assets, one must credit the bank account. So this records the purchase. Vehicles was debited and bank was credited. Kind of like an asset swap. Cash for vehicles. That's recording 1st of September 2004. Purchase of a vehicle, $300,000. The general ledger will look like this. There's the 1st of September in the vehicles account. There's the purchase. It was recorded in the general journal this time, $300,000. Now what I've done, a little bit of revision on balancing an account. In order to balance this account, we go and credit the credit side with $300,000 in order to make the two sides equal. And then the first day of the next month, which happens to be, we balance this at the start of 2005. So 2005, January 1st, the balance in our vehicles account is $300,000, meaning that we have vehicles to the value of $300,000. Well, they cost us $300,000, as in an asset account like vehicles, the historical cost price is recorded, and that balance resulted from a purchase in September. So we start the new year with a balance of 300,000. Purchase of the vehicle and the balance at the start of 2005. So now record in the general ledger accounts all the depreciation for the year ended 2004. We recorded the purchase. Now the next step is to record the depreciation up until the end of the year. The question was record the depreciation at the end of 2004 and also the transactions for 2005. But we're at year end 2004 and now we need to record the depreciation. And if I rub that out, it says they depreciate at year end 2004. We recorded the purchase, now we're doing the depreciation at the end of the first year we've had this vehicle. Depreciation is at 25% per annum on the reducing balance method, and we've had this vehicle only for 4 months, September, October, November and December. So the calculation would be 300,000 times by 25% times by 4/12, and that should give you 25,000. So that's depreciate at year end, the end of year one. We've had vehicles only actually for 4 months. That is the depreciation. 31st of December 2004, depreciate for 4 months at 25% per annum using the reducing balance method. Just for the record, in the first year that you depreciate an asset, the straight line method and the diminishing balance method or reducing balance method will be the same. It's only in second year of depreciation where there will be a difference between straight line and diminishing balance method. Right, if that's posted to the general ledger, depreciation gets debited. Why? An increase in expense. The rule says debit, so the entry is done on the debit side, the date December the 31st. The contra account or the other account is accumulated depreciation on vehicles. This went through the general journal and it's 25,000. So depreciation was debited and accumulated depreciation was credited. Why? Because this is seen as a decrease in the value of the vehicle, which is a decrease in assets, and therefore it is credited 25,000 Rand. Record in the general ledger accounts all the depreciation for the year ending 31 December 2004. So that was the first year we had this vehicle. We've recorded the purchase and we've recorded the depreciation for the 4 months that we've had this vehicle. There I did mention that depreciation is an increase in expense, therefore the account is debited according to the accounting rules. Right, let's move on. On the 1st of July 2005, the vehicle was sold on credit for 250,000. Record the disposal of this vehicle, the sale of the vehicle. There's the date, 1st of July 2005, our second year we've had this vehicle. It has been sold on credit for 250,000. Now what we need to do is we need to depreciate up until the date of the sale, which is the 1st of July, from January to the 1st of July. And that is 6 months. We debit depreciation and we credit accumulated depreciation. Now the amount was the 300,000 purchase price of the vehicle less the accumulated depreciation. There was only 1 year and we just calculated that 25,000. You must take the 25,000 off, because this is the diminishing balance method or reducing balance method. It's the same thing. So you take off the accumulated depreciation balance from the previous year, which was 25,000, times by 25%, and we had this vehicle for 6 months in the current year, and you will see that comes to 34,375. Depreciation, expense. Increase in expense, debit. Accumulated depreciation on vehicles, decrease in assets, credit. Now this here is the entry in the general ledger. On the 1st of July, when this vehicle was sold, debit depreciation, like I said, increase in expense, and credit accumulated depreciation on vehicles. That was the depreciation from the first year. The 34,375 is the depreciation up until the date of sale in the second year for 6 months. Record in the general ledger accounts all the depreciation up until the date of sale on the 1st of July. Okay, let's move on. You know that now. Increase in expense, debit. Now we need to transfer the cost price. And how to transfer the cost price? We will go and credit vehicles, because vehicles looked something like this. That's V for vehicles. 300,000. To take the cost price out of the vehicles account, we must credit. That's the credit side. That's the debit side. We must credit vehicles with 300,000. There it is. And we will take this to the asset disposal account. So we debit asset disposal with 300,000. That's the transfer of the cost price. And in the general ledger accounts, what has happened here now is we had a balance in the vehicles account on January the 1st. The balance brought down was 300,000. Now on July the 1st, the vehicle was sold. So the cost price through that general journal was transferred to asset disposal. And in this case here, we actually don't have any vehicles on our books because we only had one vehicle. But sometimes you can have 10 and there still would be a balance to the vehicles account. But we're looking at this one vehicle that was bought and sold. So the cost price is transferred to asset disposal. Now we need to transfer the accumulated depreciation to asset disposal. And accumulated depreciation looked like this. If we went and got the balance, that's accumulated depreciation. Don't want you to get confused with asset disposal. The transfer of the accumulated depreciation to asset disposal. So on the credit side of accumulated depreciation, we had 59375. In order to transfer the accumulated depreciation of this vehicle that we are selling to asset disposal, we must debit the account. There it is, debit 59375, and we credit asset disposal. And that's the transfer of accumulated depreciation to the asset disposal account of the vehicle that we are selling. So now that just happened. It was transferred to asset disposal and it's 59,375, and this accumulated depreciation on vehicles is actually closed because that is the only vehicle that we have. Now in the asset disposal account, this is important, You have the historical cost price and you have the accumulated depreciation up until date of sale. And by the way, the historical cost price or the cost price minus the accumulated depreciation gives you the book value or the carrying value. Okay, there's a little bit of information, but we still need more information in the asset disposal account. That was the transfer of accumulated depreciation to asset disposal. Record the sale on credit for 250,000. Accounts receivable, this is on credit, so we're still going to receive 250,000 Rand. Accounts receivable is an asset, the value of money that should be coming in at a future date has increased. Increase in assets, the rule says debit, and we credit asset disposal with a selling amount of 250,000. Remember, if this was for cash, it would have said bank and not accounts receivable. That is the sale of the vehicle on credit. Now in this asset disposal account, we now have the sale as well, the accumulated depreciation up until the date of sale, and the cost price. And accounts receivable was debited. Remember, increase in assets. This is a little bit like a debtor. We sold to a debtor, someone who has an account with us on credit. It's an asset. Increase in assets, 250,000. That was a knock on the door, so let's just pick up where I was. So accounts receivable, increase in assets, that was debited. And now inside this asset disposal account, we've got the cost price, accumulated depreciation, and the selling price. Record the sale. We've recorded the sale now. Let's move on. And I've been pressing on this, emphasizing this. 300,000 cost price. We've got the accumulated depreciation for year 1 and year 2. Got a book value. Sold it for 250,000. The 250,000 is greater than the book value of 240,625, meaning the difference is a profit because we received more money than what we had this vehicle on record for. So the selling price is greater than the book value, and there's the profit. Now we need to record the profit on the sale of the vehicle. So we are going to debit asset disposal. The way I remember this, if we made a profit from that quick calculation, profit is income, and in increase in income, the rule says credit. So I credit profit on sale of vehicle 9375. Then the other account must get debited, which is asset disposal. Remember, this 9375 is also the balancing figure in the asset disposal account. I will show that to you in a moment. So here I've recorded the profit on the sale of the vehicle. Here's the asset disposal account, and what I was talking about there is that profit. So this 9375 is the balancing figure to make the two sides equal, and that is actually representing the profit. So we added up the credit side and we subtracted the debit side. The credit side was bigger than the debit side by 9375, and we close off this account here to the net effect of this sale of the vehicle, and the net effect is a profit on the sale of the vehicle, and once again an increase in income gets credited. That's why the entry is on the credit side. And that is the end of this exercise. Thanks everyone. I'm going to post the next exercise by this Thursday, so that will be soon. Cheers.